Welcome back to the deliberations of the Citizens Monetary Policy Committee of CNBC-TV18. I've been speaking with Chairman of our committee, Dr. Pronab Sen, and members Sajjid Chinoy, Soumya, Samiran Chakraborty, and Sonal Varma. Gentlemen and Sonal, thank you very much for your patience. Sonal, once again to you. Just before the break, we discussed that inflation has been benign, core at 3.3. Does the setup look like the Reserve Bank should tweak the stance?
Latha, there's a should and a would. Should the MPC change? The answer is yes, because a neutral stance, all said and done, implies the next move could be a hike, could be a cut, could be sustained pause. But I think in terms of would the MPC change, we don't think so, because the stance change is a signal, which they think is a signal that of a rate cut, and they would be wary of sending that signal too soon. And when we've actually looked at the last 3, 4, 5 years of stance change and actual rate move, that's indeed what we see. The MPC changes the stance belatedly after the actual rate move. So given the global uncertainty, we think they will not change the stance at this meeting as well.
Okay, got that. Won't change the stance. Let's see how everybody votes on it. But Samiran, now the all-important question of liquidity. What's your sense? There is also the bond inclusion, which will bring its own, impact on liquidity. Do you think the Reserve Bank is going to use more tools? What will they say?
So, Latha, a very interesting thing is happening on liquidity, which is that not only is the banking system liquidity pressure much lesser in the months of February and March, but even durable liquidity, which is the liquidity that RBI directly provides, that durable liquidity in the early part of March has gone up. This was continuously coming down, but durable liquidity has gone up. As a result of this, what we are witnessing is that the overnight rates, whether it's the weighted average call rate or the TREPS rate or the CROMS rate, market repo rate, everything is now coming closer to the repo rate rather than staying closer to the MSF rate. And the RBI does not seem to be fighting against it. So for context, for almost 5 months, these rates were all closer to MSF than closer to repo. The fact that RBI is allowing it to settle closer to 6.5 is an indication that the first stage of monetary policy easing might already be in place, or at least RBI is comfortable on certain aspects, whether it is core inflation, whether it is coming from global or it is coming from financial conditions, from the financial stability angle. RBI is comfortable that it can run the system now on the BAU mode of taking it closer to repo rather than keeping it closer to MSF. Now, what happens from here on, we have to see, because as you mentioned, if the bond index inclusion flows come, if BOP surplus remains exceptionally strong, then RBI at some point of time will have to consider taking off some of this liquidity through more permanent measures, more durable measures as well, like OMO sales. Our calculations seem to suggest that in the first quarter of FY25, OMO sales might not be required, but as we move in the latter part of the year, it seems that that's a possibility that RBI will have to consider. That should not worry the markets much as long as liquidity is ample enough to keep overnight rates anchored towards repo rate rather than getting them anchored at MSF rate.
Okay, OMO sales. Well, there is also currency in circulation that may increase, we thought, but it's not increasing. Point taken, Samiran. Soumya, anything you want to add on liquidity? Rupee that the MPC should be concerned about? But the more important question I have for you is, any more macroprudential steps that the RBI might announce? You are with the biggest bank. So tell us, unsecured loans already the Reserve Bank is chasing. Anything else?
No, Latha, I think today, just for the sake, today the credit data came till the month of February. It's exceptionally strong at 25.3 trillion. And the important part is that the sectors which are growing are other than the unsecured one. The agriculture and the MSME sector growth is 26% of the overall expansion. So it's almost a broad-based. Now, having said that, regarding the liquidity and the exchange rate, I think the improvement in liquidity in the month of March was more because of the government has started to spend. Because if you remember, at some point of time, the government outstanding cash balances were around 5 trillion. It has now moved down to 2 trillion. And as you know, that we are actually moving on to a new system of this management of government cash balances, which will remain outside the banking system and with the RBI. So that will mean that in the future, if the government goes ahead with the move of this just in time, it will continue to make the government cash balances the elephant in the room, and the entire liquidity will be driven by that factor. So that means that the VRRR injections with the RBI has been doing will have to do. But the interesting trend to note in the next fiscal year is basically the capital flows because of the bond inclusion indices, possibly a larger capital flows because of the bond inclusion indices could take away some of the inherent idiosyncrasies with these government cash balances. And maybe if the liquidity get into too much of a surplus mode, the RBI can think of liquidity measures in between. But my sense is that as of today, the FY25 will open up challenges and opportunities for the Reserve Bank in terms of liquidity management. And at some point of time, that will become more crucial rather than the inflation control, which seems to be better off at this point of time.
Point taken. Actually, it has been that way, isn't it? Liquidity has concerned them more than macros like inflation. Okay, Sajjid, let me come back to the neutral rate question. Jayant Varma actually raised it when he spoke to me after the minutes were announced, that actually the difference between the real growth rate, the inflation rate and the actual interest rates is 200 basis points. This is restrictive, he argues. Now, who is to say that Ashima Goyal also won't argue like that? How do you think we should think about this real rate?
Like I alluded to in the case of the US, Latha, there are just so many moving parts that it's not possible to have strong convictions in what the neutral rate is. So just to make this easier for viewers, when central banks think about setting policy, and any kind of typical Taylor rule would say you need to have some kind of anchor. What is your neutral rate, neutral real rate? What is the rate at which the growth is at potential and inflation is at target? And then you adjust that for whether inflation is above target in the cycle and whether there's an output gap. Now, what that real neutral rate is subject to a lot of uncertainty. There's a presumption in India that the real neutral rate was about 1.5% pre-pandemic, that it's come down to 1% now, and therefore looking forward 200 basis points is very tight. But remember what that real neutral rate depends on. It really depends on the propensity to invest and save. And think of what's happened in the last 3-4 years. We were beleaguered with this twin balance sheet problem for almost a decade. And therefore, there was very little proclivity to invest or to lend, and that should have pushed the real neutral rate down. But all that has changed in the last 3 years. We're now seeing the healthiest bank balance sheets in a decade, where there's a much greater proclivity to lend. We're seeing corporate debt to GDP has come down with the prospect that investment might pick up. All of that would argue for a higher neutral rate. As I mentioned in the case of the US, even though the center's fiscal deficit is coming down, if you look at the public sector more generally, center, states, PSU, we're still much higher than where we were pre-pandemic. By itself, that would argue for a higher neutral rate. Now, to the extent that we are below the pre-pandemic path, that would argue for a lower neutral rate. In other words, there are too many known unknowns. Some work that the RBI itself has done has suggested that one model in 2022 showed that the real neutral rate was, between 80 to 100 basis points. But if you just simply overlay that model with the financial cycle, the real neutral rate goes up to 200 basis points. In other words, it's not possible to have strong preconceived notions about what the real neutral rate is. I'll end by saying the fact that credit growth is running at 15-16% at a time that nominal GDP is at 9% is hardly suggestive that monetary conditions are excessively tight. So I think this will have to be another year where the proof of the pudding is in the eating, and the RBI will have to, cross the river by feeding the stones.
Well, you're almost sounding hawkish to me, but I thought Soumya sounded dovish. But Dr. Sen, that's the overall question to you. Chairman, sir, should the Reserve Bank's overall message be hawkish or dovish?
Now we have to keep in mind, I mean, in all this discussion, we haven't really talked about the forthcoming elections. And elections always introduce a very large dose of uncertainty into economic policy making. And in a situation of that kind, the RBI will have to be more cautious than they would have otherwise. So, I mean, if you listen to what, very carefully, in fact, to what Sajjid was saying, that is under normal circumstances. Risk weights now will have to be increased at least for the next couple of quarters quite significantly. So I would imagine that RBI will have to keep as much of their ammunition intact as they can and not take any precipitous steps at the moment. They'll need to just play it by the ear for at least the next couple of quarters.
Well, point taken, Dr. Sen. That's the voice of experience speaking. Yes, the political backdrop is very important. But we are out of time, so let's start the vote. The first question, obviously, what will the Reserve Bank do to interest rates? Well, let me start with you, Sonal. What's your vote?
Pause.
Pause. Okay, Samiran, your vote?
Yeah, pause on rates.
Okay. Soumya, your vote?
Pause. Pause.
Okay. Sajjid?
Pause.
Dr. Sen, well, it's a pause all over. Your vote, Chairman?
Pause. We are all on the same page.
Unanimous. That's unanimous. Let's see if there's any change in stance. Sonal?
Retain the stance.
Okay. Samiran?
No change in stance for now.
Okay. Soumya?
No change in stance.
Okay. Sajjid?
No change in stance.
Okay. Well, Dr. Sen, you think it's time to change the stance?
I would move to neutral.
Okay.
We do not know what's happening.
All right. Okay. Well, let me ask the more relevant question, perhaps. When do you guys expect the first rate cut? Sonal?
We expect August onwards.
Okay. Samiran?
We think it's starting October.
All right. Soumya?
October.
Okay. Third quarter would be again October, December. Okay. Sajjid?
Between August and October.
Okay. Well, Dr. Sen, what's your vote, sir?
After August.
Okay. Okay, then it looks like at least for the current and the next policy, we don't see too much of a change. Status quo is, but plenty on liquidity that we will hear out from the Reserve Bank, especially with the bond inclusion. Thank you very much, members of the Citizens Monetary Policy Committee, for your deliberation.